Investing in semiconductors is a great idea. The problem is everybody already knows that. And when everyone thinks an investment is good, the price of the investment goes up and suddenly it's not a great investment anymore. So I have been on the hunt to find a semiconductor company that is still a good value, and I think I finally found it. In this video, I'm going over why it's a good idea to invest in semiconductors and what makes this company so undervalued right now. Semiconductors are essential components in a vast array of technology, everything from smartphones to cars. It's an essential building block that is used to control the flow of electricity. So if it has a computer, it's going to need semiconductors. Unless World War III sends us back to the Stone Age, I'm confident that technology is going to continue to improve and semiconductors are going to continue to be an essential part of our technology. The technology around semiconductors is continually an important place to be because 60 or 70 years ago, it was a big deal to fit a computer in a single room. And now I have a computer that fits in my pocket that's more powerful than that computer that would fit in an entire room. A big part of that is the fact that semiconductors and transistors and diodes, all of these core components are being made smaller and smaller so we can fit more and more computing power into a smaller space. The most straightforward way to invest in semiconductors would be to invest in a company that produces them, like TSM. TSM, in my opinion, is pretty overpriced, and there's a lot of risk involved with TSM being in Taiwan, where it's very close to China, and China has been making public threats about invading Taiwan, so that's bad for business. Intel is getting into the semiconductor game, but they're pretty early on. They're a ways off from being profitable, so I'm looking to get a little more creative. Fortunately, I don't have to invest in a company that directly produces semiconductors to profit off of the increased demand for semiconductors. I can find a small but crucial part of that process and invest in a company that's responsible for that part. The part I'm looking at right now is lithography. Lithography is the process where circuit is printed on a silicon wafer, which becomes the semiconductor. And so the smaller that we can print these circuits, the more powerful the chips we can make. So powerful that an incredibly powerful computer can fit in the palm of my hand, whereas before, computer had to fit in an entire room. Now, what makes this company so great in terms of lithography is they have a process that is not mastered by any other company in the world at scale, and that is EUV lithography, extreme ultraviolet lithography. And the company that does lithography better than any other company in the world is ASML, Advanced Semiconductor Materials Lithography. ASML is currently trading at $640 per share. And what I love about this company is, number one, they have a great moat. They're the best in the world at EUV lithography. So they are able to make these circuits smaller than anyone else, which means if a company wants to have the highest quality semiconductors, they gotta go through ASML. So that is incredibly powerful. They also have almost zero red flags. In my automated spreadsheet, all I have to do is type in the ticker, and then I'm automatically calculating a bunch of the key indicators that Warren Buffett uses to see if they have a durable competitive advantage. And as I'm scrolling down here, cells that are a red flag automatically highlight red. ASML does not have any red flags unless I go back to 2022 because their research and development made up more than 30% of their gross profit. Warren Buffett does not like companies that have really high R&D costs because they tend to spend a whole bunch of money on R&D to keep their current customers. If their business model is hinging on being cutting edge, then they're always going to have to spend tons of money on R&D, whereas a company like Coca-Cola, and they've mastered their formula, they don't have to spend a ton of money on R&D, so they're able to be very profitable. But in 2024, their R&D makes up less than 30%, just barely, so it's almost a red flag, but we'll call it neutral. Everything else is green, all of their profit margins, their profit is going up every year, their earnings per share is going up, their long-term debt is incredibly low. This ratio right here is looking at their long-term debt divided by their profit. And so they have more profit in a single year than they have long-term debt, which means they don't have any risk of going out of business because of high interest payments. Under 5 is what Warren Buffett looks for, so that's really good. Their retained earnings goes up every single year. Their inventory and their profit are going up together. One red flag that Warren Buffett looks for is inventories going up, but the profit isn't going up to match that. That might point to their product falling out of demand. Their debt levels are staying relatively flat, where their cash is going up. Their Their operating cash flow is a little bit zigzaggy, but their shares outstanding is continually going down, which I like to see. It means the company is spending money on share buybacks, which is one way they can return value to shareholders. Next, I want to go to ASML's financials. And one important thing to note is that their stock price is in USD, but when I go to their financials are in euros because this is a Dutch company. So quickly going through their income statement, I can see that their revenues are increasing by double-digit percentages almost every single year. In 2024, it looks like they slowed down a bit. Their gross profits look really good. Operating income continues to go up every single year, and their interest expense is an incredibly small percentage of their operating income, which I like to see. Right here, I can see their shares outstanding and how it is dropping every single year, not by a ton, but 2% here, 3% here, 1% here. If I scroll down a little bit further, I can see all of their margins. All of ASML's margins look great. Gross margin 52, operating margin 33, profit margin 28, and free cash flow margin, which is the most important to me, is 30%. My method for calculating the future discounted free cash flow is I use their average free cash flow margin over the past 5 years, and then I apply that to forward revenue predictions. Free cash flow margin is just the percentage of free cash flow that a company makes from their revenue. So that way I can use their past free cash flow margin and then future analyst projections for revenue to come up with an analyst projection for free cash flow. Moving on to the balance sheet, they have 9 billion euros in cash and short-term equivalents. And when I go down and look at the long-term debt, I can see that they have enough cash right now to pay off all their long-term debt. I like to see long-term investments going up every year, goodwill going up every year, and other long-term assets going up every year. Goodwill is the premium that a company pays when they acquire another company or acquire an asset of some kind. Typically, you're going to pay a premium for another company's brand, their relationships that they have, their business is going to be stronger than just the book value that they have. So this goodwill, as long as it's going up every year, it means that they have paid the right price for those companies. Whereas if they have to admit at some point that they overprice a company, the goodwill will go down in value. So ASML has goodwill increasing every single year. Another thing I like to see is retained earnings going up every single year. The way retained earnings is calculated is you take the retained earnings from the previous year and then you add your earnings for this year and then subtract dividends. They pay a very small dividend, about 1%. If I go back to the balance sheet, I will expect to see retained earnings increasing. However, I got to keep in mind that they do reduce retained earnings by their dividend payment. So if I'm able to see retained earnings going up while they're simultaneously paying a dividend, that is really good to see. The final category I like to look at is the cash flow statement. And right here, a few things that I like to check out is their stock-based compensation. How much are they paying out? The stock-based compensation can make their operating cash flow and their free cash flow sometimes look better than it really is because they're not actually paying cash, so there's no cash outflow, but paying people in stock does eventually come back to bite you because you are diluting your stock price. So a lot of companies will turn around and they'll buy that stock back, and you can see that right here. Repurchase of common stock, ASML buys back billions in stock every single year, just about. And so that purchasing of stock far outweighs the stock-based compensation. So I do like to see that. And then also we can see their common dividends paid. The next thing that I like to look at is free cash flow. And free cash flow is calculated by taking the operating cash flow and then subtracting the capital expenditures. Now, capital expenditures are generally not a good thing. In most cases, capital expenditures are constant expenses every year that you have to update your property and plant and equipment. It's a cost of doing business. In some cases, an increased capital expenditure could represent growth. For instance, if a company is building a new plant and then in the future years, they're going to have increased free cash flow, that would be good. And I might take some of that capital expenditure and actually count it towards a company's free cash flow. But in this case, I am going to be leaving all of the capital expenditures out. 11 billion in operating cash flow minus 2 billion in capital expenditures means that the free cash flow is 9 billion. And we can see that right here. The next thing I like to look at is how is this company spending their free cash flow to benefit me? The first thing I can notice is that they paid in the trailing 12 months, 2.4 billion in common dividends and 2.7 billion in the repurchase of common stock. And that's great. I like to see dividends paid paid, and I like to see stock repurchase. That leaves about $4 billion in cash, and I can see that on the balance sheet right here. From 2023 to 2024, they have a growth or an increase from $7 billion to $12.7 billion in cash. So they are building up some cash. And then in the last 12 months, they spent about $3 billion of that cash on something. I'm not sure what they spent it on, but maybe I should look into that in the future. The next step is actually to go to my automated spreadsheet and see what is the intrinsic value of this company based on their future free cash flow. I type in the ticker and I've got 5 estimates for the intrinsic value of this company. The analyst projections right here take into account the future revenue projections by analyst. I take the past free cash flow, which is the average free cash flow over the last 5 years, and multiply it by the future analyst revenue projections. I can find those projections on stockanalysis.com in the forecast tab. I can see the highest analyst projections are putting the revenue growth in the upper 20%. The average analyst projections are still double-digit revenue increases, and then the lowest are showing revenue shrinking over the next 5 years. I have pasted those revenue projections right here, and the resulting intrinsic value calculation is for the analyst high, average, and low projections right here. The lowest analysts are saying 349 is the fair share price, and that's with revenue dropping off. This graph shows the different revenue projections. Now, this is quite a spread. I tend to lean more towards the average analyst projections when I'm doing my discounted free cash flow analysis, but it is nice to see the lower bound and the upper bound. Now, this row right here is showing my potential upside or downside. The current share price is $640, so this is representing a 45% downside, and 703 is representing a 10% upside. But remember, the prices that Stock Analysis uses are in USD for the stock price, and then it has euros for all the calculations. And since my spreadsheet pulls from Stock Analysis, it's doing all the calculations in euros. So I need to make sure I update the share price accordingly. And the current exchange rate is $1 is 0.88 euros, which means the share price should be, instead of 640, I did the calculation right here, 563. So that changes the upside quite a bit in my favor. Instead of 640, I'm just going to manually put this in 563, and then that changes the calculation quite a bit. Now I have a downside of 38%, and the average analyst projection gives me an upside of 25%, and that's on top of the discount rate that I'm already calculating. I'm discounting the future free cash flows by nearly 8%, and I come up with that from this website right here. I go to alphaspread.com and I use the cost of equity as my discount rate, and that is a pretty common practice for calculating the discounted future free cash flow. The next step is to adjust my past free cash flow margin. Currently, I'm just straight up using the average over the last 5 years. However, I do want to adjust it down because they have some stock-based compensation. Right here is where I calculate that. I am counting 100% of their stock-based compensation against. I am counting 25% of their cash acquisitions against, which they have very little cash acquisition, so that doesn't really change anything. And then I'm not giving them any credit for R&D or capital expenditures. I probably could give them some small credit, but I'm going to be a little bit more conservative and just keep it on the lower end. So that makes their new free cash flow margin 31%, which is only down 0.5%. So right here is where I adjust the free cash flow margin down 0.5%, which doesn't really impact the calculation very much. The next thing I want to do is see, what does ASML say about their future revenue? Do they give forward guidance? Because I also like to take into account what the company says it's going to do. If I go to the 2024 annual report, ASML is projecting an annual revenue in 2030 between 44 and 60 billion based on different market and lithography intensity scenarios. So they're giving me a low case and a high case. So I'm going to try entering in their projections to see what their intrinsic value is based on. Also, I should mention they are estimating a gross margin between 56 and 60%. So I also want to go back and see what is their current gross margin. I think it was 52%. So not only are they projecting their revenue to go up, they're also projecting they're going to be more profitable. Now, what is the growth rate if they're able to hit 44 billion by 2030? I did that calculation right here in 6 years because I have the 2024 revenue of 28 billion. If they're able to hit 44 billion by 2030, that is a 7.65% increase. And if they're able to hit 60 billion, that is a 13.37% increase. So I'm going to put those projections into my free cash flow flow automated spreadsheet and see what are the new intrinsic values given those projections. So right here, I've hijacked the average analyst projections and the analyst low projections with the company's own internal revenue projections. So just keep that in mind. Now, my low projection based on the company's own guess goes up to a 4% upside on top of the 8% discount rate. And then the company's upper side gives me a 32% gain on top of the 8%. So that looks really good. However, how accurate are their projections? Do they have a history of having accurate projections? I mean, they've been in business since the 80s. So the next thing I did is I went back in time to 2014 to see what did they project they would do in 2020. First, I found their 2015 annual report. If I scroll down to their future projections, this was in 2015. They thought they could hit 10 billion euros by 2020. So that was their 5-year projection back in the day. So what did they actually do by 2020? Well, I can go back in time and I can see that they actually hit 14 billion. So they exceeded their revenue projections in 2015. Then in 2020, I can look at their revenue projections for 2025. We have a projection of between 15 and 24 billion for 2025. Now, 2025 hasn't happened yet, at least the entire fiscal year is what I mean. But I can look at what they've made in 2024 and they're at 28 billion. So they've already exceeded their estimates for 2020 going to 2025. So this company has a history of actually underestimating their revenue projections and their current revenue projections for 2030. So given that confidence, I feel pretty good about their upper end of their revenue projections. That means I have a potential upside of 32% on top of the 8% discount rate. I think ASML is a huge steal right now, and I'm going to be buying this company on Monday. So their current share price, I'm filming this Friday afternoon, currently $640. Hopefully I'm able to get it at a good price first thing Monday. Next, I want to quickly review my YouTube public portfolio. This is the series where I'm buying a different stock every single week, putting $100 in the market, finding a different company that I think is the best value that I can find at the moment. On my YouTube portfolio, we have invested $1,800 and we are currently down $141. That is less than 10% in total, but a money weighted rate of return, we are down 12.25%. For money weighted rate of return, this takes into account the time in which you made the investment. So as a quick example, let's say 1 year ago today, I invested $100 into the stock market and it's now worth $50. That would mean I'm down 50%, both in total and money weighted rate of return. If on this day I put another $50 into the stock market, well, now my balance is $100. I put in a total of $150, so that would make you think that I'm down 33%. That would be true for in total, but the money weighted rate of return would still be minus 50% because the original $100 has a return of 1 year down 50. And then the $100 that I put in just a minute ago, it doesn't factor in because it hasn't been in the portfolio very long. So it's not really down or up. Just to quickly scroll through my holdings, the ones that are up a lot, we got Hims, British American Tobacco, Adobe, Canadian Pacific, and HCA Healthcare. The rest of my holdings are down. The ones that are the most surprising to me is Google. I cannot believe that Google is down 22%. This company looks like it is so cheap right now. It is such a good bargain. And another one that I'm really keeping a close eye on is Crocs. I love Crocs right now. If you want to see the previous video in this series, you can check it out right here. And I hope to see you there. Cheers. TX Whiskey.